Could you present a bit yourself?
Yeah, so I've spent 30 years in financial markets as a market maker, which means I was meant to make prices to clients internally, externally. I've spent most of my career at JPMorgan and a little bit of time at Morgan Stanley as well. So that's in a nutshell. I don't know how complete or elaborate you want my answers to be, but I'm happy to go and deep dive further. But this is in a nutshell. I was a trader, and I'm still out to some extent, and now I'm teaching now in business schools and university.
Okay, so the next question aims at deep diving into your career path. So let's do it. Could you speak a bit more about your experience, your career, the best and the worst cases?
So obviously, it's a bit cliche to say this is a high pressure career. So obviously, as a trader, market maker, you are meant to take some risks in order to facilitate client business. Before 2008, the regulation was not as strict as it is today, but we can still, and market makers are still strongly advised to take risks in order to facilitate client business. So obviously, this means that the number one metric, and it can be very reductive also and very cruel in some cases, but the number one metric is the profitability of a trader, what we call in the jargon of P&L, profit and loss. You can obviously make a lot of money, lose a lot of money very quickly. And it's important that a trader has very good risk management skills. So this is what makes the job exciting. There is usually a very quick reward or punishment in financial markets. It's important, to be aware of that. So the best moment, obviously, and I think this is what makes the job really interesting, is that when you develop a market view, and I'm sure you guys must be doing that in your respective investment. When you develop a view and that view happens to be correct in a timely fashion, and I stress the timely fashion, then obviously it's extremely rewarding. And conversely, the bad moment is when you struggle to hold on to your view because the market goes against you, and at some point you obviously have to be disciplined and reduce that. All market makers are marked to market, which means their profit and loss are calculated on a daily basis. So you cannot afford to be wrong for a long time, because then you are trading on the wrong side of the market and you are defensive, and it's not very nice. Obviously, the main difference between trading and market making and being a long-term investor is the time horizon. A market maker has usually very short-term horizon, very high trading volumes, hopefully a lot of client flow, which helps turn around his position quickly and have a lot of market color and information. I was going to say, personally, I am an interest rate trader at heart. I had a scientific background. We can talk about it if you're interested. I'm an engineer by training. I graduated from a French engineering school. And the interest rate market was really something I found really suitable to my scientific background. And specifically because I spent a long time also in emerging markets, even though I also started in G10, I think one of the very stressful but also very rewarding time in my career was when I was exposed to financial market crises, and I was exposed to a lot of them for many reasons. Emerging markets is obviously very volatile. You think about markets like Turkey, Argentina. Argentina defaulted, Turkey have double-digit interest rate, very big moves. So these are movements which can really obviously blow up a book, but also if you are the right way, can really produce a lot of money very quickly. So when you are on the right side of that, it's obviously very very exciting. At the same time, I was also exposed to global financial crises like the 2008 crisis. There were a number of crises in 1997, 1998. We can talk about them if you're interested, but Russia defaulted in 1998. You had Asia crisis. 2000, you had the internet bubble, which completely blew up. Nasdaq went from, if I remember correctly, from 6,000 to 2,000, which is a very, very big move, obviously. So all these things have helped shape my trading career and be a bit more humble, I was going to say. And also, once you go through those moves, you learn a lot. It really shapes your trading views and the way you are going to approach the markets, particularly as a short-term trader, market maker, as well as a long-term investor. So this is, in a nutshell, obviously, the good moments when you're right, you take a position, you make money, and then you feel rewarded very quickly. And conversely, when you're wrong and you struggle with a bad position. The bad moment, I was going to say also, as a market maker, when you have period of quiet market, low volatility, low client interest, obviously it gets a bit difficult and challenging, because then you have less opportunity to make money and it's less exciting. But trust me, in the 30 years I've actually traded, at some point in the year, there are always really big events, usually which are completely unforecast, completely unexpected. And, it doesn't matter how good economists and strategists can be, they always miss out on some big event. I can give you an example. 2020, you had COVID, no one saw that coming. 2022, the Ukraine-Russia war, no one saw that coming, or at least not the timing. This year, March again, the tariff tantrum, obviously everybody knew Trump was going to do stuff, but the reaction of the market was absolutely astonishing. I'm sure you must have followed that, with a 20% drawdown on the S&P 500 and a big move in currencies as well. So these also what make trading exciting, and that's why I'm still passionate today with financial market, 35 years later, because it's always something very exciting and always something which is actually going to take the market the wrong way, wrong-footed. Most analysts and strategists get it wrong. Unfortunately or fortunately, whether you look at it or not, but that means more opportunities to make money and to trade the market.
Okay, super interesting. So in this fast-paced environment as a FX trader, FIC trader, what were your main responsibilities in JPMorgan and Morgan Stanley?
So I started being what you call a STIRT trader. STIRT in English stands for short-term interest rate trading. I don't know if you're familiar with that, but typically these are traders which focus on the front end of the interest rate curve, trade short-term interest rate derivatives, or what we call FX forward. But in a nutshell, basically, because most central banks have a target for interest rate, the ECB, I think, is like 2.5% now, if I'm not mistaken. US is like just about 4%, etc. So the front end of the curve is a bit like the tail of a dog, if you want, and the front end is really anchored. So usually the front end is not going to move that much most of the time. It's not always true, but at least you have a low vol environment there and it's less risky. And that's why, junior traders tend to start there by doing funding, trading short days, like 1 week, 2 weeks, 1 month, etc. And then as you progress and you go along, you become a bit more comfortable. And I developed my trading career as market maker, which basically means literally that you have to produce two-way prices. So at any point in time during market hours, you have to produce prices where you are able to buy. This is what you call the bid side, and the offer side, where you are able to offer any products or the product you are trading. And then this is what the responsibility is, to be able to produce prices all the time. Then as I grew up, obviously, I spent time in different locations: Paris, Madrid, New York, London. I actually had the opportunity to trade pretty much any markets in this time zone. This time zone is called in the corporate jargon, EMEA, Europe, Middle East, Africa, right? So I spent my time trading G10 at the beginning of my career, which is basically all the components of the euro before the euro came to life. And then Eastern Europe, Middle East, and Africa. So I traded Russia, Turkey, South Africa, Middle East, Israel, Saudi, etc. So it was always exciting as well, because obviously market always move, but also when you start trading different markets and actually a region, it's also interesting because you discover new markets, new economy, new challenges, new products, and that's really that was really the mandate. So at the peak of my career, I was responsible for interest rate derivatives trading at JPMorgan for this time zone. Europe, Middle East, Africa. Was managing a number of branches as well, and probably had like between 12 and 15 traders under me, talking with a decent sized sales force as well, etc. So this is also, you need to obviously develop the relationship with sales who are talking to clients, and then develop your market share, etc. So I was running basically the market making business for emerging market interest rate trading in this time zone.
Okay. And so after this long career as a market maker, how did you transition from trading to teaching?
So it's a good question. Obviously, in the back of my mind, it's funny because everybody told me you can't be a trader all your life because it's stressful. It's like, always compare that to high level sports. If you are a professional footballer or tennisman, you can't be professional at 50 years old. It's impossible, right? You don't have the stamina and the energy and the body. And in the back of my mind, I always thought, I really enjoy what I'm doing. I want to do it for as long as I can. And in fact, 30 years for a trader is actually a very long time. But in the back of my mind, I always thought, I wanted to prepare my second career. And so a number of years before I left the city of London, before leaving trading, I actually developed a number of teaching opportunities. I started teaching at Dauphine London, then ESCP London as well, Cambridge as well in the business school. And then I started doing that either late afternoon, early evening. So it was a bit challenging for me because I was working full time at the time. So it was a bit stressful. But now that I have left trading full time, I actually can really fully devote myself to that. And it's really enjoyable. And the reason I did it is simple, is because, as you can imagine, you develop so much experience and expertise after many years. It's a bit like becoming a coach once you have played. So you can transmit your knowledge to the next generation. And I know most of you guys who are involved in finance are really passionate about it. And if I can transmit a little bit of my passion as well and expertise, I think it's a win-win situation. It's really meaningful for me. It can help you guys for your career.
Super.
And now, if you had to look back at your career, would you change anything?
Would I change anything? Obviously, you have times where you are unsure. You have tough times. I didn't mention this tough time I had in my career, which was in 2000. So I was hired by JPMorgan historically, and in 2000 there was a bank called Chase Manhattan in the US, which actually bought JPMorgan. So it was quite a stressful time because we were bought by a different bank and we literally had no idea what was going to happen. We also knew that, as it happens sometimes in merger, you have duplication of desks and function and people. So I actually knew that Chase Manhattan was also trading the same product than me. So it was very clear that there was no space for both teams. So it was a bit difficult in terms of not knowing what was going to happen. What I did discover, and this is one of the reasons why JPMorgan is such a powerful bank today, is because they became really expert in managing mergers. And JPMorgan today is the result of probably 15 different mergers and acquisition over the last 30 years. One of the guiding principles they had to this day is that it is very much performance driven and meritocratic. So they will look at the two entities which are merging, and they will really look at every level and try to pick up the best people at every level. So I was lucky to be picked up, obviously, and every time we had another merger, it would be the same exercise where it's kind of maybe stressful, but in a way, in terms of the organization, this is how they manage to keep the best and make it better every time. They keep everybody on their toes, and this is how you can build a stronger organization every time. It's completely the opposite of, I don't want to pick up on French organization, but sometimes, in some French organization, you basically have a job for life, and you're not going to be moved, and you do your job well, fine. Even if you don't do your job that well, too much in danger. In corporate America, in most companies, you're not stuck in your job. You are going to be evaluated every single year, and if you do your job well, great. But if you don't, then people will challenge you, and in the worst cases, I mean, you will be removed and fired. Unfortunately, this is what happens. But this is also the reason, the secret for the dynamism of these companies.
Okay. So, in your opinion, how would you define a good trader, and what qualities really make the difference now?
So this is a very classic question, and over the years, obviously, we've been scratching our head, especially when we hire people. How do you identify good traders? Is it possible to actually, we even ask ourselves, are there any schools which are producing better candidates than others? And you're probably not going to be surprised to know that not a single university in the world or school have found the magic recipe for producing good traders. You actually have very, very smart institution, call it Harvard or Oxford, etc., which produce people who are very smart but can be very bad traders actually. And conversely, you have some institutions which are less prestigious who actually produce very good traders. So to me, the secret ingredients is about, number one, what I was really looking for in a trader is the discipline. The discipline is the ability to think, have a trading view, put on a trade, but also have the character to recognize that you can be wrong. And in fact, all the traders are wrong at some point in their life. There's not a single trader in the world who can say I'm always right. That does not exist. In fact, good traders are those who are statistically right 60% of the time, 70% of the time. That's already a very, very good ratio. Okay. So what's important to know is that a good trader is the one who can handle the times where he is wrong, and he's not going to just be stuck with the position, let the losses run forever, and then basically dig a big hole. That's, I think, what's really important. One of the second quality I personally found, and I have experienced it in my life as a trader, is a trader does not need to be the smartest person in the room. Far from it. A good trader is someone who can listen very well and who can make a summary of what he hears and pick up the important information. And I can tell you for a fact, this is like a true statistics. 90% of the profit I have generated for the companies I've worked for did not come from my own ideas. It always came from strategists, other traders, colleagues, clients. You talk to a client, you try to sell something, and actually the client comes back with a different view or feedback, and you realize actually that makes a lot of sense. So I keep telling people, I know there are a lot of cliche in the market, Pierre Chartier, I'm sure you've heard about it, the arrogant traders. But I think true traders are actually very humble because they listen and they recognize when they are wrong, and they become very humble because the market makes you very humble. The market is going to hurt you many times in your career when you are a trader. And what's important is to be disciplined and to listen and to be able to react to those times.
Okay. And so, what are the common mistakes that you've seen junior traders make on a desk?
So one of the common mistakes, obviously, is not to have a plan and not to have a stop loss. So you have a risk, you have a view, you go along the market side 100, the market keeps going down, and you're like, oh, I can't stop out here because too much, it's going to come back, etc. Being stubborn with the position. You need to have a plan, and the plan needs to be thought of in a very cold fashion. You buy something at 100, your target is 120. If it goes to 95, then you have to have some sort of stop loss, and have a plan and stick to it. A lot of bad traders actually have moving targets with a stop loss, and they run position and becomes a big hole as well. The other problem there's a big mistake, is that there is this temptation when you're a trader to always take risk. Because if you take risk, you might make money, okay, you might lose, but you force yourself to take risk all the time. And that's a very big mistake, because in order to take risk, you need to have strong conviction on a particular trade, okay? If you don't have a strong conviction, don't take risk. In fact, using capital of the bank or the fund you're managing, it's actually expensive. You should only keep that ammunition, that capital, only when you have a very strong position. And in fact, a lot of my junior traders would run risk because they were given risk by a client, and I would ask them, why do you run this risk? Oh, a client gave me this risk and I couldn't get out. I'm just hoping that market will come my way. You always have to reduce risk and make your book simple. Avoid complexity as much as possible. Complexity can cost a lot of money, and always reduce risk when you have no views. Okay, the worst that can happen is when you have risk and you don't know why, and then you start losing money, and it's terrible because you're like, why do I have this risk? I'm going to stop out, and then you lose money, obviously cutting your losses and locking those losses. So risk, you have to be very stingy with your risk, and you have to reserve risk taking for the strong commitment, strong view that you have during the year. And it doesn't have to be every day. It can be, once a month. It can be once every 2 months. In fact, the best trader investor, which I know, usually only have 2, 3, 4 view per year, and that's where they make a lot of their money and their profits. You don't have to have views all the time.
Okay, amazing. Thanks so much for sharing all those information. According to what you explained regarding discipline and all mistakes that junior trader often do, from your experience, which cognitive bias is the most important, is the most dangerous in trading?
So I don't know, maybe Thomas, you attended the presentation I made the other day.
Yes, I did.
I have a whole chapter on that. But to summarize very quickly, I think one of the most dangerous, and it's dangerous in investing, also dangerous in life, by the way. It's what I call the confirmation bias. So when people take risks, say you buy a stock at 100, and suddenly some people are going to start absorbing only positive news, meaning news which are going to push this stock higher, and sort of black out or ignore any bad news. That's because they are in what I call a wishful thinking mode, which is, oh, you're hoping that you're going to make money. So you say, yeah, this is the right position to have. Oh, by the way, and this article is positive. Yeah. But you seem, your brain suddenly is going to black out all the bad news, which is exactly the opposite of what you should do. The best investors and the best trader I've come across during my career are the ones who are going to always look for the other side. So you go long a stock and you are going to look for all the bad news which possibly could hurt you. And you are going to constantly evaluate that and say, okay, does this make sense? Could this hurt me? Does this news put in question my scenarios? At the beginning of my trading day, when I decided to buy this stock, maybe this incremental news, whether it's bad earnings or whatever it may be, maybe this news should make me change my mind. And like I said the other day in the presentation, one of my best conversations I used to have with clients were the ones which were challenging me. I was promoting a trade investment or an idea, and clients which push back literally for like an hour on every possible angle. And yet they will invest at the end of the session because they will say, okay, fine, I have exhausted all the negatives and I actually agree with most of what you say. So now I'm happy with my analysis and I want to go forward. But really, like I said, in real life, we all are polluted by confirmation bias, Instagram and Twitter, etc. You are going to click on you're going to click on, I don't know, a left-wing political article or right-wing political article. You're going to be fed constantly by the same ideas, same people. And this is going to basically exacerbate and develop and satisfy your bias. And the algorithm is not going to send you any other story which could contradict that. That's really dangerous in investment, obviously, but also in real life, because then, this is also what your generation is suffering from. And I can see it because I'm a lot older. You can see a fragmentation of political views, or in any subject, people are just entrenched in their views and they drift apart. And I think it's quite dangerous.
Okay, so here's the reason why listen is very important and be open-minded is also very important.
Absolutely.
Okay, thank you so much. And according to your point of view, in 10 years, what kind of trader will succeed, especially regarding the role of sustainability in finance over the long term?
So what's important, and I've seen this throughout my career, is that technology has always had an impact. I'm gonna give you a brief example. When I arrived, everything was on the phone. Literally you pick up the phone, buy on the phone, and then someone literally would take a pen like this and a paper and write down the tickets. I bought 100 shares in Amazon or whatever. And you had like the old-fashioned, like in the post office, where you could timestamp the ticket. It was literally medieval. And then someone would literally input by hand the ticket, etc. So obviously this was ridiculously long. And believe it or not, in the first year of my career, it was like that. And I was screaming in disbelief that how do we have that? Today, obviously, you click, everything goes through, confirmation are matched, payments are made automatically, etc. So technology has always had an impact. This is one example. Today, obviously, the challenge for your generation is how does artificial intelligence going to impact, and it's already impacting. How does algorithmic trading, how does machine learning is impacting? So to me, in essence, I think those who are going to succeed are the same people that embraced technology 30 years ago. Because first of all, you actually need to understand what trading and investment is about. What makes market move? What are market fundamentals? How does market reprice? Who are the big players? Who is driving? What are the drivers of the market? So trading intelligence is very important. And then obviously you need to be aware of technology and the progress. And you need to embrace that. Because like I said, I think in my last session, on my webinar, when Barclays suddenly is implementing electronic trading for euro swaps across Europe, everybody had to follow because they were the first one, and obviously client loved it because they were like looking at the screen, seeing a price blinking on their screen automatically. They would just click on the price and the swap was executed, booked on their system. They didn't have to do anything and their risk was probably updated as well. So whenever there is a progress, embrace the progress, be aware of it, and see how you can use that progress to your advantage with your clients in order to gain market share. Never lag transformation and progress, because if you lag, you're just going to be losing market share, and the market will go away. So understand the markets very well, fundamentally, from a macro standpoint, and then embrace technology as well. I think that's the winning combination.
Okay, thank you.
Thank you. So we talked a lot about your trading career, and we would like to deep dive now a bit more in your education career. So what motivates you as a lecturer, and what message do you want to pass on?
So I have to be honest, I was really fortunate to discover during my end of degree training period and first job, I really discovered a passion, which is financial markets. And really, when I say a passion, is to a point where I was waking up in the morning and actually looking forward to opening my screens, going to work, etc. So I know it's not easy for everyone to find your passion, but really that passion drove me throughout all my career, through ups and downs. And I felt that, when I was kind of finding my second career, I felt that, this passion was so strong that it would be a shame not to be able to transmit it to the next generation. And this is what I do. The spirit of my teaching is to take my students away from a classroom and to put them in a trading floor situation. Say, okay, this is what's happening. This is why the market moves. This is also why I always do market updates at the beginning of my session, to really give a flavor of what is happening in the markets and how investors are looking at the world. And it's really interesting because, history does not repeat itself. I mean, there are some patterns, but the beauty of markets is that, you need to understand the economy, you need to understand how to price assets, but most importantly, you need to understand market psychology. And a market psychology is a multi-dimension problem. You can think about it as a first degree, second degree, third degree. It's a bit like playing poker, and not understanding, the level of bluffing that someone can have. So it's a very exciting game, very challenging, very difficult. no one has deciphered it. No one can say, okay, I know what's going to happen. That's what makes it so exciting. So it's really the love of the job and financial markets. I wanted to transmit the bug basically to my students, and hopefully a few of them will have it.
Yeah, and that's great.
Nice.
Some club members were not able to attend today's meeting, and a question that came up when we were preparing this meeting is, what advice would you give to students who want to work in sales and trading?
So obviously, I'm not going to break any news to you, but today it's a lot harder to go into financial markets. It's a lot harder to break into top-tier institution because the demand is so big. So I think you need to today. You obviously need to be really interested in financial markets. Try to follow them. Try to do as much simulation of interview as possible, etc. It is very hard. It's very competitive, but I guess beyond the obvious, which is continue to be involved in financial markets, understanding, reading the financial press every day, every week. Maybe get involved in some training games that you probably have in your club, etc. That can only enhance your profile and that can only be attractive to a potential employer. But I'm not going to obviously lie to you, etc. I can see it with my students. It is hard out there. There's a lot of demand. But at the same time, I don't know if you are involved with some of the schools I've been teaching. But for example, the finance Master of Finance at ESCP London is actually really well rated, and a lot of my students actually end up in top tier, institutions like Goldman Sachs or JPMorgan, etc. So there is hope if you have the right degree or the right approach, the right experience, the right drive. You can still be hopeful.
Yeah, I'm sure you're right. We also studied in different renowned business schools such as Schema, EDEC, ESCP, and even I will start my M2 at ESSEC. But I have another question for students that are less focused on things like sales and trading. For students who want to still work in financial markets or in other fields related to finance, what key lessons from your career still applies, do you think?
So I know your generation is very much focused also on work-life balance, mental health, etc. So I didn't talk about this, but it's obvious to me that trading particularly is not for everyone, and it's a very challenging job. And I think it's important to be honest with yourself and realize what are the skills you need. Being able to resist to the pressure. I always tell my students, being in a competitive environment, which is the case in sales and trading, particularly in trading, it's not for everyone because some people thrive in a competitive environment. When you play tennis or football at a very high level and you're good, it actually pushes you because it makes you better. But it's not for everyone because some people actually, and there is a tipping point where pressure becomes so strong and so hard that it can become destructive. So I think the first advice is that it is important to be honest and realize it's not for everyone. I would say trading is a lot more stressful than sales for a very simple reason that sales don't run risks. They have the pressure of printing the business, talking to the clients, selling the product. But once they sell the product, they don't have to worry about what's going to happen. Personally, as a trader, I was going home many times thinking about my risk and if I had the right risk, etc. Sometimes you think about it over the weekend. So, it's a mindset which is not for everyone, and you need to be able to live your life with that. So what are the other jobs, in a trading floor? I mean, I have a full presentation about the jobs. You can work in structuring, you can work, obviously mid office, back office, control, operation, business management, compliance. There's literally dozens of different jobs in, I'm not even talking about, technology today, data science, machine learning, AI, etc. So there are plenty of it. I spent my life in trading, which is why I can talk about it for forever. But if you are interested in financial markets and you're looking for something which may be less direct exposure to profit and loss and numbers all the time, then yeah, you have a whole bunch of jobs. And I don't know if you attended my very first webinar, but I'm happy to do another session if you guys are interested to talk about the different jobs in details in a trading floor. I mean, that presentation lasts more than an hour plus, so happy to look at that if you're interested.
Yeah, all of this is very interesting. The point you just mentioned is, especially interesting because I spoke as well with two students you had in class, Moulay and Ibrahima, for some time, because we were thinking, is now a good time to start a career in markets or should we wait? So according to you, is today a good time to begin a career in financial markets given the current uncertainty?
I mean, uncertainty is fantastic for financial markets. Uncertainty means volatility, means more hedging. I give you a very simple example this year. Until March and the tariff tantrum, a lot of investors didn't even bother look at their currency exposure. They thought, there was this almost like mechanical movements when markets were rallying, when risk was rallying, the dollar would weaken and vice versa. So the dollar had some sort of buffer effect. And suddenly this year, that correlation broke down very, very badly. So suddenly there was huge amount of hedging in FX and a lot of clients started to be involved. You can imagine for people who are in FX trading and FX hedging, this is obviously very interesting. So uncertainty is actually very, very good for markets, for traders, for banks and the sell side in general. There's nothing worse than having a very boring trend where people are buying any asset and just goes up every day because then, you just buy and hold and it's not very exciting. Even for investors, to be fair. I mean, they make money, obviously, they're happy, but what you need is uncertainty and volatility. This is why what makes markets so interesting to trade and so exciting every day is to be able to predict those movements. So yeah, I mean, there is never a good time to start. It's always good to start at any time because there's always, and like I said, you can take every year for the last 5 or 10 or even 30 years, I will find you every year a massive event which will unforecast and generate volatility. The only period I can think of, there was a time where, the period, I'm sure you've heard about QE, quantitative easing, when central banks were injecting a lot of liquidity because of recession fears, etc. And basically, there was yield compression, so interest rates were really pushed lower. And in doing so, volatility also was being pushed lower. And I always give this metaphor. It would be the equivalent of having a patient who is really sick and you give him a lot of anesthetics. So obviously the patient is not going to move much. He's going to feel like a bit high and don't feel the pain. And you prevent the market from reacting. But really, real life is uncertain. Life is uncertain by definition. And uncertainty means, you have different scenarios. And that means, the path toward the future is going to go through ups and downs. And this is what real life is. And financial markets have this role in economies to actually give you a heads up, a red flag in terms of, okay, this company is not doing well. This market is not doing well. This currency is weakening because we don't like what's happening in the bond market. It has a function. I know some people, politically left-wingers, etc., are going to say, oh, capitalism is terrible, But actually, it's like the body giving symptoms. If you are hurting in your stomach, then maybe there's something wrong. And this is what financial markets tell you. This company has problem. This bond market is a problem. We've had issues in the bond market in the UK a number of times recently, and I think it's very important because it's not me, but take it from doctors. This doctor says that if pain did not exist, it would be a real problem because you would be sick and you would not notice that you are sick. Because pain effectively is a symptom of sickness. And that's exactly what financial markets are doing in the real world. They give you symptoms.
Okay. Yeah, that's a great point as well. In Kota Investment Club, we come from many different countries. For example, Quentin comes from Taiwan. I come from Germany. And so for us for those aiming to reach roles in sales and trading, which locations would you recommend us to start our career? Maybe London, Paris, or Geneva, New York, Hong Kong, Singapore. Are there some specific places you would recommend us?
So for Europe, I mean, until Brexit, it was obvious that London was the center of Europe from financial markets perspective. Obviously, after Brexit, you had a lot of banks who have actually shifted some of their workforce, some to Frankfurt, Paris, Dublin. So it has kind of changed slightly, but I would still say that London remains a very big center for financial markets. And in fact, pretty much all the banks in the world have an office here. So I think you have to realize that most big career will be made typically in big centers like New York, London, Singapore, Tokyo, but it's Hong Kong. Yeah, it's a big center. It's obvious that for tax reasons, some other center will have some prominence. Like people talk about Abu Dhabi because of tax reasons, etc. But look, if you look at Geneva, for example, as a center which to some extent had some tax incentive. A lot of hedge funds went to Geneva and came back to London, went back to Geneva, came back. So they keep going back and forth. But I think the major centers still have a huge appeal. New York, London, Tokyo, Singapore, Hong Kong. Maybe Abu Dhabi a little bit today, but the big cities have a lot more opportunities as far as I'm concerned.
Okay. Yeah, that was our last question. In fact, thank you very much for your time.